24 seconds away from the opening bell in New York City this morning. Good morning. What a week we've seen in the bond market. Not so much in equities. Equity futures are just about positive on the S&P on the week, on the S&P 500 into Friday. Just about positive too, up 1/10%. As the opening bell, switch out the board and get to the bond market. On the week, your 10-year yield up around 9 basis points, down 3 this morning, just sub 2%. Just on twos, up more than 20. And we did much of that in one session alone, off the back of CPI and some Fed speak from the St. Louis Fed President Jim Bullard in the exclusive interview here at Bloomberg, talking up the prospect of maybe 50 basis points in March and perhaps 1% by the time we get to the summer on a Fed funds rate. Euro dollar south of 114, 113.89, down 1/3%. Crude into the 90s, had a little look at 91 earlier, 19.95 right now, positive a little more than 1%. At the opening bell then, here's a state of play with 30 seconds in. We advanced 1/10%, a marginal move higher. Feels like a big move compared to where we were on futures a little bit earlier this morning. Top of the pile, energy up 0.5%. Bottom of the pile, the financials down 1/3%. We'll get to the banks in about 5 minutes time. The materials down by 0.6%. Anastasia Amoroso of iCapital said this: it's been such an unforgiving macro environment that unless you deliver top of the line beats and upgrades, you're not going to get rewarded. Taylor Riggs all over earnings season. Taylor, at times it's been tough.
Yeah, indeed, John. And what's so interesting is I know after the big CPI print report yesterday, we've really been focused on the consumer and the ability for these companies to pass on those costs to consumer. But actually in the last 2 years, it's those producer prices that have actually risen a lot more. If you think sort of the input of the raw materials, those are up 10.6%. Now, of course, consumer prices are still up 9.4%. But this just puts into perspective sort of the broad-based inflationary pressures that pretty much everyone is experiencing at this time. Let's speak, though, to the quote that you just mentioned at the top of the segment, because when we take a look at earnings season, fourth quarter earnings beats by segment, for example, industrials actually did better. They had bigger earnings growth than they had the sales growth. So margins there are healthier. But you're seeing fewer earnings beats on, let's say, staples and discretionary. And that's showing that there is a little bit of that margin compression and maybe taking more time to pass on those costs to consumers. I know we spoke about Chipotle earlier this week. We could go on and on about that. I will spare you. But what I will say is that at least with some of the companies that, let's say, have really strong brands, right, or are able to pass those on costs to the consumer, they're actually doing a pretty good job. You think Chipotle, you think Harley Davidson, you think Peloton. And that's in a big contrast, John, to the companies like Clorox that we saw also earlier this week, saying it's going to take us a few years to really sort of boost up those margins back to some of the earlier levels that we've seen.
And what is it you want from Chipotle, just to give you the opportunity?
Cauliflower rice.
Okay, thank you. I feel like that's a fee just for your appearance, just to rant on about cauliflower rice. Thank you very much, Taylor. Looking forward to the close a little bit later with Romain and Caroline as well. Tons of earnings, all about retail next week. Under Armour out, getting ahead of the crowd, topping analyst estimates, but raising concerns over, guess what, quote, material impacts from supply chain constraints. Abby has more. Hey, Abby.
Hey, John. Well, a brutal decline there for Under Armour right now at the lows in the pre-market, down just about 2%. And the funny thing is they put up a great fourth quarter, similar to some other companies, big volume, beating profit estimates, beating sales estimates, but it's all about the future. And yes, they are talking up supply constraints. Now, one thing to remember for this company is a lot of their apparel comes from Southeast Asia. So the supply constraints there, the way to fix it, air freight. That is very costly, and that is really weighing on the company for sure. Now, relative to companies reporting next week, Walmart is really the big one on Thursday. We'll get a read on big box retailers and the health of what's going on for those companies relative to the supply chain. Something we already know about some of the consumer staple margins. They're already seen being squeezed. So the question is, how bad will it be? For the fourth quarter, it's expected to be 8.9% overall for the consumer staples space, down from almost 11%, and then perhaps rising a little bit in the second quarter. But if the big box retailers give a similar story to Under Armour and some other companies, it could be kind of ugly. This could be why a lot of these stocks are down more than 5% this year, John.
Abby, one of the headwinds from last year, we've got to think about it again, all over again this year too. BNP cut their price target on the S&P down to 4,900. They say this: higher rates, particularly higher real rates, are a potential headwind for equities. We're acutely aware, based on the Q4 2018 episode, that when central bank tightening coincides with earnings expectations falling, the market can sharply correct lower. Dan Skelly, does that resonate with you? I think it does.
It does, Jonathan. And look, we were calling for a little bit of a trickier market this year. Mike Wilson's call was for 4,400 to start the year. So that's a tad lower than we are today. Let's keep in mind, Jonathan, a lot has been discounted already, right? So if you think about the average stock in the S&P 500 is down 15% off the highs. The average name in NASDAQ down 24% off its highs. The average Russell 2000 small cap is off close to 35% off its highs. So a lot has been discounted already. We do see slower earnings growth this year. It's going to be a year for much more opportunity and active bottom-up stock picking.
Jean, you're still overweight equities, and I just wonder what's bringing you comfort right now, given what I've just heard from Dan Skelly?
We're still modestly overweight equities. We've dialed down, the overweight coming into the year because of the greater, I guess, Fed uncertainty or central bank uncertainty we were seeing, confusion being one of our key theme. I think the main headwind, in fact, going forward for us is not so much rates going up. I think they're going up, but I don't think we're going to see deliver the kind of hikes, the 7 hikes for this year. We don't see that in the cards. So ultimately, we're going to see a more muted path. So that's not really the headwind, but the confusion is real. And there's a Fed premium that needs to be now compensated. And that's really more where the headwind is coming from. So we still think ultimately, it's going to be a more supportive environment than is currently anticipated. And so we're still overweight, but it's bumpier, much bumpier.
Can margins hold up? Kelly Kaminsky, I want to bring you this quote from Clorox and a CFO. Said this is the 4th inflationary cycle we've gone through in the last 10 years. Historically, it's taken us about 12 to 18 months to offset cost inflation and rebuild margins. I would tell you, though, in this case, because of the extreme level of inflation we're dealing with, I expect it to take longer. I do think it's going to take several years for us to rebuild margins. Now, of course, this is a very separate company from, say, consumer discretionary. This is a staple-like company. So I want to come to you, Kelly, and ask you about margins. And I wonder whether we can make some broad-based assumption on what's going to happen, say, at the index level of the S&P, or whether we've got some concentrated consumer price tolerance that some companies, some sectors can take advantage of still.
I think that's a good question, because for us, the way we see it is more sort of as a pipeline issue. You start off with raw materials, and all of these things have to trickle down through and see which companies can actually pass these through or not. And from our side, one of the challenges, the key inputs, which are those raw materials, are still faced with this mismatch where at 7% inflation and 2% 10-year, we have an implied negative rate, which means that commodity prices and inputs are still going to remain challenged until we can alleviate those issues. On the other hand, for margins, you are seeing some companies, other companies, being able to actually pass some of those through. So I think it's going to be the same story this year. Watch those commodity prices, see if we can find a way to abate them with some policy response. And secondly, see which companies are actually able to navigate some of these, challenges to margin in general.
Dan Skelly, what I think will be interesting when you and I catch up, Mike Wilson too, is that increasingly as the year progresses, there's a feeling that we de-emphasize the year-end index targets and we start talking about single names with you, Dan, in a much, much bigger way. Can you give me a flavor of that now, Dan?
You're already starting to see that play out in the last 4 or 5 weeks of earnings season, Jonathan. Even among the big mega cap FANG names, there were tremendous swings among the names that were the winners, the names that were the losers. And so, look, what I would say is, broadly speaking, we agree. We do think there's going to be more dispersion, more opportunity to decipher winners from losers. In terms of sectors at that perspective, we still like sticking with energy, given that inflation offset, given geopolitics, we all know too well in the near term. We like healthcare as an area of earnings stability, some decent dividend yields in that space amid a higher volatility market. And we think that's growth and innovation that's reasonably priced. Now, look, the last thing I would say is technology. And amid the software and growth space, that sector has seen tremendous volatility the last several weeks. What we would say there is don't bottom fish in terms of the speculative names that are reliant on funding and have balance sheet issues. Focus on the high free cash flow, quality names that are taking share in what will continue to be a digital transformation economy post-COVID.
Joe, one winning sector over the last few weeks, particularly the last month, year to date, has been the banks. It's picked up in the US more recently. In Europe, we're up 13%. on the Stock 600 banking sector. Bank of America came out with this morning, Jean. I'd love your input on it. We lower European banks and value versus growth stocks from overweight to market weight. After more than 50% outperformance since late 2020, EU banks are already priced for the modest further upside for the US 10-year bond yield that we expect. Jean, just on the financials, a lot of people have gone there, sat there, almost wanted that exposure as we expect higher interest rates in the Treasury market and bonds at the policy rate, the ECB, the Federal Reserve. Is that overdone now for you, Jean?
Well, I would stress that the the backdrop favorable for our financials having to do with what we think the yield curve is going to do over the next few months and years, I think is constructive. We've seen some flattening of the curve over the last few days, despite the fact that long-term rates have been increasing pretty materially. I think there's a bit of a policy mistake being priced in. As I said from the beginning, we don't think that's going to happen in the end. I think we're like in the middle of confusion right now. This narrative will get clarified hopefully over the next few meetings. And once that's the case, then I think we're seeing like a gradual steepening of the curve that should be supportive of that sector.
Katie, your views on that yield curve? Bank of America and Mark Urbano this morning came up with some really big numbers. 7 hikes this year, $1 trillion of balance sheet reduction this year, next year too, and potentially an inverted yield curve. Is that your base case now too, Katie, going into year end? Or are you a little bit more constructive on maybe getting some steepness back in this curve?
I have to admit we're relatively bearish, and we're actually seeing some very strong signals that yields are moving that direction. Since we follow market prices, it's been fascinating to see how strong the moves have been. So for us, yesterday was basically just a confirmation. So from our side, we see that this problem is going to have to be alleviated and that yields are going to have to go up. And from a historical perspective, we're also seeing that these signals are, from a technical perspective, very consistent with what would be a rising rate environment going forward. So I think that for us is a pretty strong view, especially in the short term.
And typically things turn out okay, more often than not. Dan Skelly, whenever we have scares like this and the market gets jittery, things turn out okay. Even after Q4 2018, things turned out okay in 2019. Even after spring 2020, this equity market, things turned out okay. That's why I want to finish on the RBC quote that I read out a little bit earlier on with Mohammed and read it again. The current pricing is close enough to the hawkish extremes of likely outcomes that the risk reward of fading it is too attractive to pass up. Now, Dan, my question would be, where would you fade it? Now, I know what your base case is, but if I could guarantee you that this Fed can engineer a soft landing, that we get back to a sustainable level of growth, that inflation comes down in a material way, and we all feel nice about the economy again, what would you be buying today?
I think you want to be buying some of the tech areas that have cyclicality attached to them, i.e. semiconductors. Some of those areas that are going to, once the market stops thinking we're going to have this policy mistake or even thinks that we're going to have an inverted curve and a potential economic recession, I think what's going to be in favor again then will be the tech names with cyclicality. So I think semis would be an interesting idea in that particular theme.
Dan Skelly. Jean Bavin, what about you?
I think I would not dismiss that the macro call here. I mean, I think you're right. Like it's maybe a bit more dispersion we're going to see and so on. But like the main driver is an inflation story. I think this is going to play out at the broad market level. I think during the course of the year. And I think we've talked about peak hawkishness. I think for me the frame is we're at peak confusion at this stage. And I think we're going to see more clarity over the next few months, and I think that's what needs to be tracked.
And that's one thing we could all agree on. Katie Kaminsky, same question, final word to you.
I think my view is more that if you look at interest rates, higher rates aren't going to be a problem eventually. We just got to get there. And so from that perspective, longer term, I do feel like equity markets and the economy will stabilize through this movement, but it's just going to take a time to get to that point. And so I'm just hopeful that, we can do this in a way that's smooth and that equity markets will be able to take the change in rates, and some of these issues will dissipate from supply chain issues.
Well, they've taken it well this week. The S&P basically up 0.1% on the week so far, even with this rate hike conversation. The S&P at around 4,500. Katie Kaminsky, thank you, alongside Dan Skelly and Jean Bavin. To the three of you, thank you very much. What a week it's been. What a couple of days we've had. a 24-hour period where the 2-year yield has just absolutely surged. 15 minutes in, coming up, the Biden administration continues to pledge its unwavering support for Ukraine.
What we're committed to in the case of Ukraine is doing everything we can to defend Ukraine's territorial integrity, its sovereignty, its independence, which unfortunately is being challenged right now by Russia.
The update from Washington, up next.
American citizens should leave now. We're dealing with one of the largest armies in the world. This is a very different situation and things could go crazy quickly. They're not. That's a world war. When Americans and Russians start shooting at one another, we're in a very different world than we've ever been in.
President Biden urging Americans to leave Ukraine. The NATO chief Jens Stoltenberg warning of potential conflict, saying the following: there's a risk for a fully fledged invasion, but there's also a risk for other types of aggressive actions, including attempts to topple the government in Kiev, hybrid cyber attacks and many other types of Russian aggression. Russia continues to deny any plans to invade Ukraine. Joining us down in DC is Bloomberg's Anne-Marie. Anne-Marie, an important call coming up a little bit later this morning.
Yeah, just got confirmation from the White House. We heard it earlier from the Canadian Prime Minister's office. President Biden is going to be talking with the leaders of a number of European countries like Germany, Italy, Poland, the United Kingdom, NATO heads, and this is in regards to what the next steps are when it comes to the tensions regarding Russia and Ukraine. We don't know yet, Jonathan, what the next steps are on the diplomatic path. We've had a flurry of meetings happen, but really nothing concrete has come out of them. We did hear from Antony Blinken, the Secretary of State, as he wrapped up those Quad meetings in Australia, and he's saying we're now in this window where we could see a Russian invasion. Although, Jonathan, as you said, we should note, Russia still denies that they intend to do that.
AMH, the president trying to get a lot done this week. Also a conversation with King Salman in Riyadh in Saudi Arabia to do something about what's happening with energy. Can you just tie everything together for us on the week we've had so far?
Well, when it comes to energy, Jonathan, the administration's at a very interesting moment. You have a few things happening. One, tensions with Russia are going to increase the premium on oil prices. Two, you have this outreach to the king. We should note it's to the king. The administration is still trying to figure out what that recalibration with Saudi Arabia is going to be, because they maintain that it will be counterpart to counterpart, not engage with Mohammed bin Salman, who is the individual that is responsible. At the same time, there are talks of a potential Iranian nuclear agreement, and they're coming up to a point at the end of February where they said they would need to see action on that. I don't think the Saudis are going to move on any more barrels in the market until they know and they have clarity on if there's going to be a resurgence of Iranian exports. So it's a very interesting times where the geopolitics is also having a risk premium into what we are seeing in the financial market.
It's a serious, serious issue. And AMH, let's just sit on it for one further question and response if we can. I think we've got to emphasize how complex these issues are and how difficult this is for this administration. We've got very serious issues on the international scene, and it's hard to reconcile the foreign policy goals with what's happening at home domestically with the economy, inflation, CPI. That's how tough it is right now for this President, Anne-Marie.
Well, that's why the timing of this crisis with Russia couldn't have come at a worse time. The administration is trying to get gasoline prices down. Russia is obviously a key member of the OPEC Plus and one of the biggest exporters of oil and gas in the world. So you have these very precarious, interesting foreign policy moments. Also, the Iranian nuclear deal. If there was an Iranian nuclear deal, you're going to see thousands of barrels of oil hit the market and the price come down. That would help them domestically. So you have two different factions of the White House dealing with different issues, but they will affect Americans and the American consumer. But Jonathan, when it comes to what this administration needs to focus on domestically, because what Americans want to see, that is inflation down. Americans are not going to vote based off what happens in Kiev. They're going to vote based on their grocery bills and based off the price of gasoline.
Nothing about this is easy. Nothing about it. AMH down in Washington. Anne-Marie, thank you. Crude right now, 92.40. WTI, 90.93. Brent at 92.40. At the top of the hour, consumer sentiment numbers here in America. Before we get there, let's get the sector price action. This session has turned out okay for now, at least in the early part. Here's Abby.
It is pretty interesting right now, John. We do have a gain for the S&P 500 in the sector. Action on the day and on the week, very interesting, being driven by rates because, of course, yields are coming in just a little bit today. That is helping out your traditionally rate-sensitive sectors such as utilities, staples, healthcare, and real estate. Those high dividends look a little bit more attractive. Now, financials are higher, too, probably on the big backup on the week, but you were just talking about oil above 90. That's why energy is on top, up 1.4%. Now, on the week, super interesting, as you were mentioning earlier, it doesn't feel like an up week, but the S&P 500 is up about 0.5%. Higher for a third week in a row, the best, longest winning streak since November of last year. Now, this is where the rate action really is taking place. Now, materials, a cyclical sector, that's the top sector on the week. Most sectors this week are actually higher. Banks, not surprisingly, getting a bid, up almost 3%, as that two-year yield you were mentioning is just stunning, up about 25%, 25 bips, I should say, on the week. Now, on bottom, the two worst sectors, utilities and real estate. That's because when those yields go higher like that, those dividends just don't look as attractive. Tech, interestingly, higher.
Abby, thank you. 23 minutes in. Equities up. Yields backing away at the front end. Just a little, just a little. Coming up, your trading diary. Packed full of Fed speak for next week. From New York, this is Bloomberg. Let's call it 26 minutes into the session this Friday. We're up on a week, up on a session, up a third of 1% as yields back away. As stocks, bonds look like this, 2s, 10s and 30s. Yields up on a 2-year in a massive way yesterday, up the most since 2009. Through 160 this morning, briefly backing down now by a couple of basis points to 155. That's the price action. Here's your trading diary into the weekend and out into next week. University of Michigan consumer sentiment, top of the hour. ECB President Christine Lagarde speaks Monday. PPI in America Tuesday, retail sales and FOMC minutes on Wednesday. Jobless claims on Thursday and a host of Fed speak through the week. Evans, Brainerd, Bullard, Mester. Take your pick. From New York, thank you for choosing Bloomberg TV. This was the countdown to the open. This is Bloomberg.
From the financial centers of the world, this is Bloomberg Markets with Alex Steele and Guy Johnson.
Well, 30 minutes into the U.S. trading day, Friday, February 11th. Here are the top market stories we are following for you at this hour. More hikes on the table. Global bond yields soaring as traders anticipate as much as 175 basis points worth of rate hikes by the end of the year. Now, even Goldman Sachs calling for 7. And pressure on earnings, supply chain issues, and labor shortages persist. We'll hear from two top CEOs on how they're handling it. Uber CEO Dara Khosrowshahi and Philip Morris CEO Jacek Olczak join us this hour. And Russia Russia risk? Well, that remains. Russia and Belarus hold their largest military exercises in years. President Biden warning American citizens in Ukraine to leave, now saying things could, quote, go crazy quickly. From New York, I'm Kriti Gupta with Guy Johnson in London. Alex Steele is off. Welcome to Bloomberg Markets. Guy, lots to chew on when it comes to yields, when it comes to the economy, when it comes to Washington.
Absolutely, and inflation right at the heart of the debate right now, Kriti. So let's talk about the data that is dropping onto the Bloomberg terminal right now. The University of Michigan data, keenly anticipated. Let's take a look at what the numbers are telling us. The headline number comes in at 61.7. That is a big miss, down from 67.2. The survey 67 there. The current expectations number is the one that holds up, 68.5, down from 72. The market, though, looking for 72, but it is down quite sharply, but compared with the miss that we're seeing on the expectations number, looks all right. The expectations number comes in at 57.4. That's down from 64.1. The expectation actually that it would tick a little bit higher, it's dropped. But then we get to the main event, the inflation data that the University of Michigan brings us in terms of consumer expectations 1 year out, 5 to 10 years out. What I find surprising here, given the numbers I've just given you, is that the 1 year inflation number actually remains fairly static. The prior number 4.9, this number comes in at 5.0, so this is 1 year out inflation, 5%. Now remember, CPI yesterday, 7.5. Well below in terms of where the consumer sees things, and the 5 to 10, 3.1. So, which is consistent with the last number as well. So in many ways, the consumer, according to the UMich data, actually doesn't see the same inflation story over this year as maybe we're seeing in the headline data right now. Now, maybe there's an expectation that it rolls off towards the back end of the year. That's certainly been something that has been talked about a great deal. But I'm surprised that that number is as static as it is. So let's break it down. Let's figure out what is happening here. Richard Curtin, University of Michigan Surveys of Consumers Research Professor and Director, joining us now. Professor, great to see you as ever with some instant analysis of this number. I want to talk about the 1 year inflation figure that is embedded in this data. Yesterday we get a CPI print that is 7.5. This number is 5. Why do you think the consumer in the data that you're seeing at the moment is more sanguine on the inflation outlook?
Well, thanks for having me on, Guy. I think they're more sanguine because they're not, I should say, they're not more sanguine about the levels they expect. Inflation is a serious problem for consumers. And when we start out the interview, we ask how they're doing financially and then ask why. And in response to that question, more than a third of all households complain about lowering living standards due to inflation. So inflation is a serious problem given that it had been very low for a very long time. And they think that the 5% this year, which you correctly assume that it would mean that we have a contained inflation rate at the end of the year to balance out to 5, they are quite negative about.
Richard, can you talk to us a little bit about where this data set might particularly go as you start to see some of that fiscal stimulus impact wane just a little bit more?
Well, I think the stimulus impact is going to be perhaps negative in that we're seeing a lot of the regulations that were first passed expire. And so, and some will mean that, forbearance and rental assistance has stopped. I think that right now we still have a consumer that has plenty in their savings and reserve funds on balance across the entire population. And so they may not cut back immediately, although I expect some cutbacks in spending, but they may tend to keep their reserves intact and help the economy by maintaining their spending at current levels. But I don't think that's, I think we're headed for a less than 2% increase in consumer spending in the first quarter. And my best guess is it will be less than 1% change over the last quarter, which was already at a miserable level.
Interesting stuff. Richard Curtin, University of Michigan Survey of Consumer Research Professor and Director. We thank you so much for your time. This is Bloomberg. Well, more and more banks are joining the choir of 7 rate hikes. Well, that brings us to our question of the day. Can stocks take it? Goldman Sachs, Bank of America, both predicting 7 hikes. Let's ask Julie Beal, portfolio manager at Kayne Anderson Rudnick. Julie, let's put that question to you. Can the stock market digest those 7 rate hikes?
Well, I think we might not have a choice, right? It's not going to be up to us. It's not even really up to Jerome Powell. It's really a function of how inflation plays out. Investors are sort of pestering their boyfriend, what's going on for, Valentine's Day, and Jerome Powell doesn't quite know yet. And I think that's the thing that we have to remember is that it's going to be in reaction to how inflation is playing out. And because inflation can spiral, he needs to be able to control that sooner rather than later.
The danger is that if we get 7, Julie, that we end up breaking the economy. The danger is that we end up inverting the curve. If the Fed is too aggressive, is there a danger that that happens? And if so, what would that mean in terms of the equity market performance that you're looking for?
If the Fed is too aggressive, I think the problem then we have is that for sure we'll head into a recession, just as we have in years past where, Volcker broke the back of inflation. And so you would have a near-term recession where, the cost of borrowing is super high and it has ripple effects throughout the economy. It impacts valuations, it impacts fixed income markets as well. It would cause a lot of turbulence, right? But I think the bigger problem is that the way that inflation can spiral, particularly in a consumer economy, right? If you get to the point where consumers are starting to change their purchasing behavior because they're worried about inflation, that is very hard to break that cycle. So I think the cost of a recession, which is just part of a normal cycle, right, is better than having spiraling inflation that you can't control.
I'm really glad you brought up the consumer here because I think demand destruction is a really key part of the inflation you're seeing, whether it's gas prices or your grocery bill. That's, of course, not just hitting the bottom line of corporate America, but for a lot of American wallets as well. I'm curious, though, about the corporate story, simply how much of that or how much of the stock market is actually protected from that demand destruction.
I would say, sectors of the B2B are probably more insulated than sectors that are directly serving the consumers. And so, we are pretty hesitant to be very out ahead of our skis in terms of, owning consumer sector names. A good tech name that's serving other B2B markets is more attractive to us. It has more recurring revenue, for example. And so for us, when we're coming into this kind of turbulence, we're looking for earnings predictability and durability. Yep. That's what we're trying to protect our portfolios with.
So, Julie, what was your takeaway from this earnings season? We're coming to the end of it.
I think it's been interesting, right, because the earnings have actually been pretty positive. The margins have really held in there. There's been lots of pricing power, but the commentary and the guidance has been actually pretty disappointing. And I think that's just companies and CEOs being unwilling to get out in front of not knowing what their labor costs are going to be, their input costs, and obviously there's still the threat that there is demand destruction. So I think they're hesitant to really provide large guidance that's in line with the very healthy fundamental results that they've actually been delivering.
Julie, very quickly, we have to talk about tech here. Where does tech play a role in the portfolio? Is it that long duration sensitive asset, or is it an inflation hedge? How do you view it?
I think with technology, it really depends on what you're looking at, but I think the move away from narrative-driven, stocks with extremely high valuations is no longer nearly as attractive as it used to be for investors. And I think instead, we're looking for those who can deliver sustainable growth and who have earnings, like God forbid, I think that in a time where there's so much uncertainty, people are going to be much more focused on high levels of recurring revenue and looking at how a company performed in the last recession. That is what gives us confidence that it can manage through what could be the next recession.
Julie, we'll leave it there. Have a great weekend. Really appreciate your time. It's been a brutal week, so I think everybody deserves a good weekend right now. Julie Biel, Portfolio Manager at Kayne Anderson Rudnick. Still ahead, Uber delivering an ambitious outlook for fiscal 2024. We had the call yesterday, the gathering of investors, some skeptics out there, certainly on the long-term trajectory for this business. Dara Khosrowshahi is coming up next. I'm really looking forward to this conversation. This is Bloomberg.
All day yesterday.
So we now welcome our Bloomberg television audience and our radio listeners worldwide. Uber's CEO Dara Khosrowshahi joining us now. Also with us, of course, Bloomberg technology anchor Emily Chang. Emily, why don't you jump in the driver's seat, take things away.
Guy, thanks so much, Dara. Thank you for joining us today on the back of your Investor Day yesterday. I want to talk about some of your projections. You're saying Uber will hit $5 billion in EBITDA in a couple of years. That's many, many times more what Uber is doing today, but light of what some analysts expected. You got the stock down now 2 days in a row, already down again this morning. What do you think it is that investors aren't seeing?
You know, it's tough to tell as far as market short-term goes. As you know, with interest rates increasing, inflation expectations increasing, I think the market has been a difficult market for a lot of companies out there. But if you look at the fundamentals of Uber, not only long-term, but even this last quarter, we had our audience grow by 27% on a year-on-year basis. We had gross bookings highest ever, almost $26 billion, up 50% year on year. And we had our second quarter of profitability, and we projected this $5 billion target ahead of us. All of the metrics as it relates to the business are headed in the right direction. I can't predict market movements short term, but long term, you see stocks move with the fundamentals. And right now, the fundamentals are absolutely going the right way with Uber.
You said prices are starting to come down, but inflation is hitting record levels elsewhere. And I'm wondering if you're concerned that that's going to hurt demand coming back from the platform because your riders are paying more for everything else.
If anything right now, I think it's a great concern theoretically. But if anything, our marketplaces have been more supply constrained than demand constrained. We had plenty of demand come in, both for rideshare. We've had plenty of demand come in for delivery as well. And as you can see, the top line is super healthy. What we had historically had a tough time with was getting as many drivers and couriers to join the network as we wanted to. I think the good news for us now is we're up to 4.4 million earners on the platform. We added 325,000 earners onto the platform last quarter. And as a result, the marketplace is becoming more balanced. I do think inflation is here to stay. But for us, it's about balancing both supply and demand. And right now, that balance is in a really, really good place.
Dara, good morning. It's Guy in London. Uber is I guess what we would call in the financial markets a long duration business. We're looking further out for profitability, for the big returns that are going to come towards us as the business matures. As interest rates go up, that potentially becomes tougher and tougher. You said a moment ago you see sort of near-term volatility, but you're more confident in the long term. What gives you that confidence in the long term? It would seem like a tough moment in time to have longer term projections.
Well, I think we're seeing it in the business right now. The business is coming back faster than ever before. We're record gross bookings levels. And we said actually that we're going to hit free cash flow positivity this year. So I think with Uber, you have the balance of, hey, in the short term, what have you done for me lately? We're delivering profits. We're going to deliver cash flow profitability. Our Q1 is stronger than Q4. That's not true for some of our competitors. And at the same time, we're putting a marker down on long-term growth of 22 to 26% and significant incremental profits as the business grows. So I think we're a balanced story, which is you want improvement next quarter, you want improvement next year, you got it. But you want long-term growth, 5 to 10 years with increasing margins, we have that as well. I think if we deliver on both the short and the long term, we're going to be just fine.
You talk about that balance. Can I just talk about the balance within the business right now? Delivery obviously was a huge hedge for you during the pandemic. Is delivery and ridership on a sort of fulcrum? Does one go up and the other one go down, and vice versa as we come out of the pandemic? And what happens with ride sharing as well as we come out of the pandemic as well? Where does it fit into that? Is there a long-term dent because of the pandemic, or does that start to fade fairly quickly?
We're seeing, so I think that from a long-term standpoint, both rideshare and delivery are on a long-term glide path up. And especially as it relates to mobility, we're adding taxis, we're adding two-wheelers, three-wheelers. We're adding shared rides. We're adding reserve. We're innovating around the mobility sector pretty aggressively. And the same thing with delivery, which is people want more stuff delivered to their homes within an hour, and we're adding grocery and alcohol and many, many other categories. So you're going to see both of them move up, but cyclically based on openings and closings, while one is strong short-term, the other one maybe a hedge the other way. And I think to some extent we're seeing it in Q1, which is the Omicron wave hit. Obviously, things are getting much better now. But for example, a rideshare competitor in the U.S. is going to have their EBITDA down Q1 versus Q4, while ours continues to rise. So what I talked about with our investors is we're an all-weather company. You get secular growth of mobility and delivery, and whether or not the world is open or closed, the two hedge against each other so that you've got predictability and strong long-term growth.
Dara, you've got a huge Super Bowl ad campaign featuring Gwyneth Paltrow, Trevor Noah, Cousin Greg. Cousin Greg is in there, trying to drive the point home that Uber Eats delivers more than things that you can just eat. How big a business do you think non-food delivery can be as part of Eats? And is all this marketing spend paying off? I mean, these are pricey celebrities.
They are, but they're worth every penny. We're seeing Uber Eats. It's absolutely becoming a cultural phenomenon. And the Tonight I'll Be Eating campaign, we wanted to throw this other twist because our non-food product, it's at a $4 billion run rate. It's growing very, very quickly. We're really doubling down on grocery and other products as well. And we wanted to get the awareness out there. What we're seeing is that consumers who start buying groceries and other items on Uber Eats actually start using Uber Eats more and more. So not only is it a new growth path for us, it actually cements our relationship with our customers and can be another growth path going forward. The ad has gotten great response, and we're looking forward to the Super Bowl.
We're preparing for an onslaught of crypto and metaverse ads, and I'm wondering if any of this has convinced you. Is there any chance of Uber accepting Bitcoin in the future? Are you having conversations about this internally? Like, could it happen someday?
It definitely could. We're having conversations all the time. I think right now what we see with Bitcoin and some of the other cryptos that they are quite valuable as a store of value. The exchange mechanism is expensive. It's not great for the environment. As the exchange mechanism becomes less expensive, becomes more environmentally friendly, I think you will see us lean into crypto a little bit more. So we're absolutely watching it. And if you say, is Uber going to accept crypto in the future? Absolutely, at some point. This isn't the right point, but we will.
Okay, we'll look forward to that moment and you updating us as to when it's going to be, Dara. I sense there's some vagueness around that at the moment. Can I take you to London, where I am right now? You're backing the Mayor of London's plans to shift the way that we charge. The congestion charge is likely to go. We're likely to shift potentially to a pay-as-you-go, a pay-per-drive, pay-per-mile type of model. Do you think backing the Mayor, Sadiq Khan, is going to help you in terms of your license renewal, which I think is coming up in March? And I'm also wondering kind of the bigger picture here. If we head towards this kind of model in London, is that a big step towards pooling? Because I'm assuming that would be a huge step forward for Uber.
Definitely. We're backing the mayor because we think these kinds of charges, it's the right way forward. Congestion is not good for the city. It's not good for Uber. And what we believe in is that, the vehicles with the greatest amount of utility should be the ones that use the roads. I think utility increases as vehicles become more environmentally friendly. So 10% of our kilometers now in London are EV vehicles, and we're going to keep pushing that up. And I absolutely do believe that pooling creates more utility, more than one person in a car, and that is an area of the business that we're investing in. We're also actually investing in a lot of developing markets in high-capacity vehicles. Can you get, 10 people in a bus, and you can call it Uber Bus, but it uses a technology that we have in terms of routing, pricing, matching, and takes it to the next level. So we're looking forward to partnering with London going forward, and congestion, again, lowering congestion is in everyone's interest.
Last quick question, Dara. Your head of mobility, Andrew McDonald, said getting taxi drivers will unlock that next chapter of growth. And I'm curious what you're prepared to offer them, given that taxi drivers, many of them around the world, don't have a lot of fond things to say about Uber.
Well, I think that what we have to offer them is more demand, and it's essentially e-hail riding demand. Ultimately, whether you're an Uber driver or you're a taxi driver, you want to get paid for your time, and time with your car empty is not constructive. It's not good for anyone. It's not good for the environment as well. We are now building out tool sets that are specially dedicated to taxi fleets, so that you as a consumer, if you want to take a taxi or you want to take an Uber, or you want to reserve, you can. So it's great for the consumer. But taxi fleets hopefully will work with us, and as they do, they'll get more demand, which we think is a win-win.
Dara, we'll let you get back to work. Sounds like you got plenty of things to get on with. Really appreciate your time as ever. Dara Khosrowshahi, thank you very much indeed, sir. And of course, our thanks to Bloomberg's Emily Chang. Okay, what's coming up next? We're going to pivot to a completely different business, but a supply chain story that is still impacting, hitting the cigarette sector pretty hard. We're going to be talking to the CEO of PMI, Philip Morris International. That conversation is coming up next. A supply chain certainly a factor, but taxation may be insulating this sector from inflation. This is Bloomberg.
Well, ETF investors are bracing for Fed tightening as U.S. inflation surges. Bloomberg's Abigail Doolittle is looking at the flows. Abby, what do you see?
The Creedy on the week, it really is showing that investors are worried about inflation. If we take a look at the SPY, we are going to see a small gain, as is true for value ETF, up even more, up 1%. However, the growth ETFs, they are lower. And this, of course, has to do with the idea that high-tech, high-growth companies, that the valuation comes under pressure when rates rise. And certainly they are rising this week. That 2-year yield up about 25 basis points yesterday. Simply stunning, and the expectation that there could be more rises ahead for yields, even though today down a little bit. But the mixed picture, and the mixed picture is also yesterday we had the QQQs, the 5th biggest outflow ever. That's the degree to which investors were spooked, scared yesterday in terms of thinking that if yields keep rising, that these growth stocks are just not going to be attractive, taking their money out. So if we also flip up the board, we are going to next see that these are the biggest outflows on the week. So this is, again, all about the high growth, the risk on, momentum, your QQQs, your LQD, bond ETF, HYG, that high yield bond ETF, IWM, small cap, and then SPY, the smallest amount of outflows, the best diversification there with that S&P 500. And then finally, speaking of bond yields and the outflows for HYG and LQD, they are really pretty strong in the week. This is a different chart that we're looking at, but the put open interest for both HYG and LQD, very, very strong as investors are turning more and more bearish, Guy, as we've been hearing about on credit.
Absolutely. A firm focus on what's happening there. Abigail, thank you very much indeed. Let's turn back to the earnings picture, though, for now. Philip Morris International, PMI, says its full-year earnings are going to be higher than last year. Decent outlook, but the cigarette maker, amongst other things, flagging inflation concerns. More on the supply side than the demand side. We'll talk about that difference in just a moment. Joining us now is Philip Morris International's CEO, Jacek Olczak, joining us from Lausanne. Very nice to see you. Thank you very much indeed for your time today. Inflation is the word on everybody's lips right now, and a lot of it is coming from the supply chain. You focused on that when you spoke to investors. The statement talked about it as well. Jacek, just talk to me a little bit about what kind of input inflation pressure you're feeling. What is the supply chain story doing to you right now?
Oh, thank you for having me here. Actually, I have to correct one thing. You call me a cigarette maker, but, to be true, I am less and less of a cigarette maker. We are, much more focused on alternative to cigarette, to smoking. There is an inflationary pressure, coming from, upstream on the components, especially the electronic components, which we're using for the alternative to smoking. We have a less pressure from the materials which we're using in our products, like leaf tobacco, etc. But there is some pressure. I think they are manageable, and I don't think they're going to be a long-lasting. We're all aware about the shortages. I mentioned components. There's also some constraints around the logistics, the air freight. Is getting more expensive these days. I think for 2022 we will go. We issued the guidance yesterday, and I think in 2023 a big part of these pressures will just go away, will disappear.
Jacek, thank you for joining us.